Good morning, everybody. I am not a realtor. I'm the state representative in the 189th district, and I thought it was really nice to be asked to be a moderator because I get the calls from both ends of short-term rentals. So I am so happy to be here and honored to be the moderator. And I just want to get right to the questions because I know, time is of the essence. And
Real estate term.
yeah,
Time
and
is
that's
of
right.
the essence. Us
Sign
realtors,
now.
I say it all the
Sign
time.
now. So thank you again for having me here. The first question that we have is about the state of the market. So I'm going to, if it's just you two, I'm just going to start with Xander first, if that's okay. Is it buyers, sellers, or balanced? And does that vary by community for short-term rentals?
Is it buyer, seller, or?
Balanced. And does that vary by community?
Varies by product type and varies by community. So properties that have very high revenue potential, your 5, 6, 7 beds, outside an HOA, good regulatory environment, I would describe it as a extreme buyer's market. The market to me for that segment of properties is similar to what the general market was during COVID. The other types of properties with a regulatory environment is a little bit more restricted, or you're in a community that has higher per rental fees or some other sorts of challenges. That market is, in my opinion, very soft. You're talking like your 3-bed, 2-bath in a random location without really opportunity to expand or improve it.
Yeah, and I very much would second that. My focus is almost strictly on people buying and selling houses that can use as short-term rental, or at least in short-term rental friendly communities. And there's kind of been such a trend to go bigger and such a trend to have all the work done for you that has really put a price premium on it, that I almost think there's a odd math right now that 3 + 3 is 5. So for the price of a 5-bedroom, that's a good solid earner for short-term rental. You could buy 2 3-bedroom properties, and it's just because I try to get my clients to think, look, this is actually a pocket in the market that is developed because so many influencers and so many experts have all sort of pushed everybody to either go small or go big, that they forget these homes were built for a reason. You might have 3 or 4 bedrooms at home and you might be traveling with another family, but if the intent is put all the kids in one bedroom, put one parent group in the one bedroom and one parent group in the other bedroom, that's a 3-bedroom, and you can put 8 or 10 people in it. That looks to me like a great vacation home.
I hate to do this, but I was told I should have a gong because we have like 30 seconds. So I'm going to do I'll be like, because there's actually more than 10 questions. So thank you. And and by the way, I am on the housing committee in Harrisburg along with 5 other committees. So this is really important to me as I get calls from both good and bad. So I want to clear I want a clear reason to be able to tell the people that are complaining why they shouldn't be complaining and what they do, what's going on if they do have a complaint and where to go. So the next question, I'm going to start with you, Mark. We're going to go back. Are lakefront and amenity-heavy homes behaving differently? How are you supposed to know this?
Sure, they behave differently in the market because there's a very almost insatiable demand for lakefront. Mm-hmm. And the amenity piece, sure, if it's a unique amenity, but the lakefront, we used to think a premium for a lakefront house was $200,000.
Sure.
$250,000. Maybe we're at 3.
Yeah.
And so a block away, your appraisal is going to be $300,000 less. So it's almost like beach block if you're down at a resort.
Okay. So, Xander, if you agree upon this, I can go ahead to the next question of section 1.
Sure.
Okay. Are investors acting differently than second home buyers?
Absolutely. The investors are looking at things through a financial lens. They are more detached, generally speaking, from the purchase. So a lot of times we try to do a lot of due diligence on the front side to identify the correct deals. I work with a couple different partners who help as like an advisory level to kind of identify the best deals. But then once we do, you have to remember that the buyer is fairly detached. They are fairly emotionless. If the deal starts to do weird things and for some reason isn't as advertised, that's a deal that can quickly fall out of contract because there isn't that emotional attachment that you see with, second homes. You're not imagining seeing your grandkids hang out at the house and whatever it might be. So it's a different buyer profile.
Okay, thank you. And you might as well hold the microphone because I'm going to go back to you. This is number 2 on the questionnaire is business value versus appraisal value. So the first question is, how do you explain the gap between income value and bank appraisal value?
Bank appraisal value is inherently a rear view picture. Typically it goes back 6 months, maybe 12 months, and it's based on closed comps within the subject neighborhood or within a subject area, and it's a relatively narrow picture. There are properties, if you have a property with high revenue and the property is not completely depreciated, meaning it's not a total dump at this point because it's so ran through from renters, you will be able to command a substantial value over the appraised value. If you're selling that property with revenue, you can be $100,000, you can be $200,000 above revenue. Appraisers do try to make the numbers work, and we have completed sales that are substantially higher than what the appraised value is.
Yeah, because we've always heard your house is only worth what the bank says it's worth, right? When people are going to get loans and things like that. So it's good to know that it's simply not true if you have extra cash to go ahead and go over and above what the bank says.
It's a limiter. If the properties could appraise for like $1 million and they were doing $200,000 in revenue, you would sell them for 1.2.
Okay.
It's a limiter, but it's not the end all be all.
Okay. So,
Sorry, everyone.
hi, how are you? I'm Tara. We were just talking about business value versus appraisal value. And one of the second questions are appraisal gaps common? Are they still common from the appraisal?
Yeah, so appraisal gaps are incredibly common in the Poconos, and I think part of the reason is because you have just a lot of volatility in terms of the housing stock. You have a mix, residential properties right next to, a high-performing investment property that's doing a lot of income. And so I think over time, the other thing that's going on in the Poconos is property values are going up. So I think that's also creating volatility. And so I do think to some degree that will be, that will kind of smooth out over time. But it will take a little bit of time for that to happen. And I do think one of the things that people, I think being next to who your neighbors are, I think really matters. And so if you're next to other short-term rentals, that's going to be good for your resale value and probably have less appraisal gaps going forward. And so that's something that I think people don't always think about when they're actually making the initial investment.
Thank you so much. Mark, to follow up on that, how should agents prepare buyers and sellers for this?
Well, if you do have somebody who is interested in an investment property, then I think you've got to try to look at comps and determine whether this was actually an Airbnb property. And if it did have a rental history, then you could figure it's going to be a little bit higher. Mm-hmm. But if it hasn't been, even though it might be right next door or the same size, then you try to get the clients to understand that you got to have apples to apples. And unfortunately, in the MLS systems, unfortunately, the data that the appraisers look at, it's not easy to determine whether a house was a rental property, was an income generating or income focused rental property, or just being used as a second home.
Okay.
Or primary.
Wonderful. Thank you. So we're put on like a 30-second to a minute. I don't have a gong though to like shut you off. Okay. We're on to the third. You might as well just hold it and we'll go right back down the line. The STR premium. So what specifically creates an STR premium?
So I think the premium comes from that it's actively short-term renting, that it's got an Airbnb listing, that you can see good reviews, you could see that the house has furnished, and that you could see that in some way the house has generated income. There are third-party tools that might give you extra numbers that give you some basis for this. But that's, to me, what we describe as the STR premium.
Okay, thank you. The next question, does proven income matter more than potential?
I think both of them matter, and I think it does matter which type of investor you are, because there's people that only want to do value add projects. But on the margin, I think when you have proven revenue, that is going to lower your risk rate. And so anybody, that becomes demonstrable of the success of that particular property. So on the margin, I think you can expect a higher valuation for something with revenue, as opposed to somebody who's going to put in a lot of money. They're obviously going to want to get compensated for that time and risk.
Thank you.
That was a good answer.
Xander, is the premium shrinking or expanding in 2025? I think I want to say 2025, and what's the forecast for 2026? I want to expand on that.
I think the premium is expanding. I think the 100% bonus depreciation that passed with the last tax bill has substantively changed our market. People will buy short-term rentals. Yes, they want to get their cash-on-cash return, which realistically, unless you're hitting an absolute home run, is probably going to cap out in the 15% range, generally speaking, on a normal deal. But you can get the tax benefits make it so attractive year one that has really spurred our market. And as long as that, for the duration of which that remains in place, I would anticipate the demand being very strong until the time at which the pricing reaches a rate that the revenue as a percentage of the pricing gets too low.
Thank you very much. Hold on to it, and we'll get you first next time. Okay. The fourth topic is top performing communities. So, Xander, which short-term rental communities are outperforming right now?
So, a holy grail for me in the short-term rental space is no HOA, uncapped occupancy, 2 per bed plus 2 or 2 per bed plus 4. So what I mean by that is if you can get a house that sleeps 16 plus and you do not have an HOA, that is able to drive more revenue, but also the appraisal becomes much more lenient. So Mike sold the property that I couldn't believe he got the appraisal at what he got it at. And it partly very much was because the property was not in an HOA. So there are HOAs that perform very well from a revenue perspective. Penn Estates, as an example, Pocono Summit, as an example, or the Stillwaters, as an example. But the ability to be outside an HOA, you have a $1 million, 1.5, almost $2 million property. The appraiser will go back and they'll use a much wider range of comps versus if Penn Estates are going to comp it against Penn Estates. If your houses are selling at 600 at Penn Estates, the appraisals are coming in at 600. But if you can get something outside an HOA and drive huge revenue and have some unique features to the property, that's when you can really get the appraisal upside. So they are far and few between. If that property exists, each of us will have 5 offers on it probably, but they are the holy grail.
Thank you. Mike, to follow up.
You didn't answer the question about the communities.
So, Mike, the follow-up question, or another question I should say, is are these regulations shifting buyer demand?
Yes.
What communities you like?
Well, no, I meant in that, like, one of his answers was like, if you cannot be in a community, that actually creates uniqueness in and of itself. But yeah, I think the regulatory environment does definitely kind of allows you to dictate a lot of things. So like Blue Mountain, for example, Estates is a really good one. They have a bunch of 5,000 square foot properties, all really nice. They actually allow short-term rentals, but the HOA has a really high rental fee of $145 per rental, and also the township only allows you to market as a 5-bedroom. And the prices are relatively high, and the taxes are relatively high. So when you add all that up, it doesn't make sense to market. It doesn't make sense to buy a 5,000 square foot property and rent it, to a small group with all those expenses.
Thank you. Mark, is this saturation impacting ADR in certain areas?
So it's never saturated. It's just competitive. And I think, no, that's an important fact because we do hear that this is a saturated market. Well, saturated market assumes that, there's too many. And I'd say we're competitive. I don't think we're at a point where it's not a wise investment. Mm-hmm. So from that standpoint, there's always volatility in the market. There are ways to stand out. I think this morning's keynote highlighted a kind of a cute, clean, cuddly, or whatever, something like that.
I like
right?
cuddly.
Right. But comfortable. But it is kind of what these houses were built for. It's what a lot of these communities are known for. There's definitely a race and a move, I say an 80-20 market where someday we may see 80% of our revenue come from 20% of the homes. We're not quite there yet, but that's kind of this amenity gold rush that is flooding things.
Okay, thank you. We'll start with Mike next. I just want to say, as the former mayor of Stroudsburg from 2015, when this whole short-term rental was taking place, there are certain areas, the R2 zones, that we said no short-term rentals. But I think that more and more these townships and, municipalities, boroughs, HOAs, they really are doing their best to make sure that you are allowed to have them and that they are in the right spots, per se. So most of the complaints that I ever get are usually from HOAs. So it's funny that we were talking about HOAs. But anyway, I'm going to go on to the next question. Okay, this is a category 5. Mike, this is about what size home performs best. So the question is, are 3-bedroom, 4-bedroom, or 5-bedroom homes leading in revenue?
Yeah, I think a lot of people like the larger homes just because in the short-term rental industry, I think bedrooms are kind of like gravity for your revenue bands. So more people are obviously going to be able to pay more. But also I think there's opportunities within those bands. I think a lot of the properties that are bigger have gotten really, really competitive. And I think there's actually opportunities with 3 and 4 bedrooms. You can find a nice property to actually provide that sort of high level experience, but at a more affordable price point.
Thank you. Thank you, Xander. To follow up on that, is ADR or occupancy driving stronger returns?
I think you need both. You need to have a high ADR and then back it into your occupancy. So if you are rented 99% of the year, but your nightly rate is $100, like that's terrible. If you're rented at $500 a night, but your occupancy is 50, maybe you need to reduce your pricing a little bit to get that occupancy closer to the 65-70% range, which is probably really the sweet spot. Now, other operators will operate differently. Some people will be like, hey, I'm going to jam someone in there every night. I'm going to reduce my rate like a hotel style. I'm going to reduce my rate. I'm going to bring someone in. The better oiled machines and efficient machines, but those properties will also depreciate faster and it's more burden on your cleaners. So you have to look at it holistically.
Okay, thank you. And Mark, for the final question is, does septic size limit upside?
Sure. And I'll go to reaffirm the Pocono's generally been known as a weekend market. And so there's only 52 Saturdays a year. So the one thing, the bigger units, just reinforcing what you guys said, the bigger units, the hope is that you draw people to stay a whole week rather than just a weekend. And that's really where the ADR and the occupancy come together, is if we can get them to stay a whole week. And that's also draws people from a little further away than just the weekend crew. Septic is a huge problem in a sense because it's not something that's well documented. So as a homeowner, or a home buyer, you try to understand the capacity of this thing. You go to a township, you ask for right to know, maybe, if you've got a good realtor, if you're good at doing your due diligence. Then you find out it may or may not have documentation, so then you got to try to test it. So in order to have legal bedrooms from STR ordinance standpoint, those actually have to be defined as septic legal bedrooms rather than just bedroom.
Thank you so much. Back to Xander. I'm trying to do it equally here. Okay, this one is for amenities that move the needle. So, Xander, which amenities consistently increase ADR?
Pool is a huge one. People like hot tubs. People like fire pits. They want to have lights around them. On the more high-end stage, you can go with pickleball courts, which have become a big factor in the market, and you can go with things like home theaters. But those are, if you want to have a really high performing STR, like the 150 plus range, those are the $150,000 plus gross range per year revenue properties. Those are the types of things that you will see.
Thank you. Mike, what upgrades do not pay for themselves?
Yeah, I think I like to think about this in terms of like kind of, you really have to, things that you might like as a second home buyer or a primary owner, you have to distinguish those between what guests are actually, willing to pay for. And so a lot of times I think like things like updating, doing a gut reno of the kitchen, probably not the most important thing. Just paint the cabinets, make it look modern, make it look updated. Same thing with bathrooms, right? Because people are coming on vacation. They're not thinking about, wow, this bathroom's so cool, I'm going to be hanging out there all weekend. They're thinking about the pool and, all those things that Xander just mentioned.
Yeah, you're next. I'm going to say those things are important to me. But anyway, the last question is design and branding now as important as location?
Yeah, I think we run into this. It's the HOA versus Poconos. Are you coming to the Poconos, or are you coming to Arrowhead, or are you coming to Lake Harmony, or are you coming to a community that might have a little bit of a brand itself? So if you have that strength in a community that has a brand, then I'd say lean into that. If you don't have one, then you probably do need a little bit more on the amenities and the design and your property to stand out.
Thank you. And just hold the mic. This one is hidden risks and traps. What are the most common buyer mistakes? Can you do that in 30 seconds or less?
Well, you mentioned septic, and that's a big one,
Yeah.
right? Because you come in thinking you've got occupancy, and then you find out you might not have occupancy. You think you can update septic, but sometimes you can't update septic because township's got some quirky rules. So I think that's important. I think a lot of people drive their decision making on these third-party data sites like AirDNA and the like, and those are good indicators, but they really make a lot of assumptions, and that's, I think, a concern that everybody should have.
So I think this is a really good question for the audience here. Either of you have anything else to add to that? Like, what are the most common buyer mistakes? Because we're all here to
Yeah, I mean, I think
Learn
I
about
think we've
this.
come a long way, just in terms of like, there's so much more education out there. I think I always kind of start with, like what property you need to buy. You know what I mean? Because if you're like, for example, this was a common one, I think back in the day, if you needed to do like $125,000 of revenue, but you buy a 3-bedroom property, that's going to be extremely hard. But I do think people come in a lot more educated nowadays. I think the other one that, people, I might be answering the next question, but people underinvest kind of upfront in what it's going to take. I mean, this is like a business. So I think of it like if you're opening a restaurant or a pizza shop, it's like you can't spend a bunch of money in the kitchen and then not put a sign up or make the exterior look good. And a lot of people have that tendency. I just want to save a little bit of money. I'll do a little bit, see how it goes. But you really have to make the investment upfront to make it a really great experience.
Thank you. Sandra, do you have anything to add to that? And what are the most common buyer mistakes?
Septic, you can take advantage of the septic deals on the buyer side because that's where you find your truly motivated sellers, the checked out sellers. The other thing that's important, and I don't know if there's another question, I should have read the questions before I came in here, but a big challenge that people have, in my opinion, is they get properties where when you have a smaller property, you can make a 20% cash on cash return, but it's a lot of work. And if you buy a property that it's like, oh, I made 65 grand, I bought it for 200 grand, and after that, my net income is $10,000, and I only put $10,000 in the deal because the way I structured it, like, it seems great, but it's a hell of a lot of work to make 10,000 actual US dollars.
So just hold on to the microphone. And how do HOA restrictions impact value?
Massively. Mike touched on it. You have a place like Blue Mountain Lake. They have big shacks. They have high taxes. It's public water, public sewer, so it's like easy to even bang a 4 into a 5. But with the per rental fee, it's challenging. There's some communities that I will not sell in. I know I'll be unpopular for saying this, but like Split Rock Resort is one that I have a very hard time selling in because of their deed restriction, because of some of the regulatory environment concerns that they have there. Now, other people sell there and say, nothing's going to happen. But for out-of-state investors where change of use risk is a substantial factor, it's a hard place for me to sell in. For a long time, I would not sell in Tobyhanna Township because their ordinance kept jerking around, going up and down and doing weird things.
You can say jerking around. It's okay.
Fine. It kept doing, they were setting caps. They were doing other odd things, setting 10-person maximum occupancy. So there's times where I guess I've paused, and HOAs themselves can definitely have a huge impact.
Do you have anything else to add on the HOAs before we move on?
Yeah, I think it's the HOAs. I mean, so much of our housing stock is in HOAs, and I think it makes such a big difference. And I know that some HOAs don't, they have their own goals, but I think one of the things they don't always realize how much their policies actually impact the demand for the real estate in that HOA, because I'm sure that all of us, we get people come in, they're interested in buying a home. They say, what HOA is that? And you tell them, and they're like, nope, I don't want to be in a gate. They got a crazy rental fee. I hear they're really difficult to deal with. I don't want to be in that HOA. And so I wish the HOAs, it's maybe better part of, us realtors to do that education. And maybe you don't care. Maybe you don't want those buyers to go in there, but it drastically makes an impact on your real estate value. So, and then you have Penn Estates is, I talked about being close to other neighbors and short-term rentals. I think, a community like Town Means and Trails is really interesting what's going on there because they don't have a gate. They have relatively low, fees, and there's, you can find land and you can build a property, and there's a ton of new construction going on there. And so the community is just getting nicer and nicer by the day. So it's there's a lot of interesting case studies about how one HOA versus another have been operating.
Well, thank you. So, Mark, I think that this question is a good one for you based on what you spoke of before. What surprises show up during inspections and underwriting?
Well, inspections, I think the simplest one, Poconos, is humid and hot, and a lot of these homes don't have air conditioning. Sometimes people forget that the homes don't have air conditioning, so half of the ones I see don't have at least a central air or system in. So, that's certainly a inspection thing that sometimes can freak people out. They hear things of rotted floor joists and they go into panic mode, and that's actually a fairly simple repair. Underwriting, as they review kind of the business side, or as a homeowner, we're seeing for homeowners insurance and underwriting on that standpoint, roofs are a big problem. They want to see roofs in the first half of their life, not later on, even though it's a 25-year roof, might even have a warranty. It gets to 15, 20, they're going to say, we don't like it, or your homeowner's insurance is going up. And I think as you look at this as the whole picture with Airbnb, it's the insurance from that standpoint rather than just standard homeowner's insurance.
Okay, so based on this topic, the hidden risks and traps, is there anything that wasn't asked in these 3 bullet points that you might want to add?
Past rental history, everybody seems to view it as a gold standard. If somebody can produce a report from Airbnb and say it's made $100,000 a year, that's not an audited report. That's a bookings that went through Airbnb. I can have Uncle Gus go rent my place. I can have him pay full fee and rent it for 3 weeks, and then go give him money on Venmo. It's going to show up on Airbnb's rental report. So urge everybody that the financial reports are all indicators, but use some common sense.
Okay, thank you. So, Mike, next topic, short-term rental due diligence checklist. So what must investors verify before going under contract?
Yeah, I think, we were just chatting about some of those. So I think, looking at the septic, the township rules, the HOA rules, there's a lot of things that maybe, again, like you don't know what the sleeping capacity is, or in a specific HOA, they don't allow pools or something like that. So if you're planning to put a pool, you need to look into a different HOA. I think, trying to get as much, if it is, there's different types of properties, but just trying to get as much information about their previous operating history. But as Mark was saying, take that with a grain of salt, be very balanced in that. And you're really trying to just do as much diligence as you can. And that's why I think it's important to work with somebody that can kind of highlight those things. But whether it's reviews or whether it's, did they open or close the pool last year? Does it have, AC? What are we looking at in terms of taxes? So I think it's really pretty much everything in that model. If you've got a model and you're looking at revenue or expenses, is you need to be asking questions about what the drivers for each of those things are.
Thank you. And then do you mind if I have a follow-up question, Andrew, to that one? Because I think it's important. And like I said, as a moderator, I get some phone calls, good and bad. And one of the questions I have about that is, before an investor goes under contract, do realtors have an ethical duty to at least go over the ordinances? Like, you can't cut those trees in front of the lake. You can't have a 50-foot concrete driveway. You can't just put a deck on. You must get a permit, because these are the type of issues that my office gets called on. So are realtors required to go over the ordinances of an HOA or a municipality for a home, or are they not? Is that the investor's due diligence to do it on their own?
I don't want to speak of what is legally obligated for real estate agents to do as a job, but I would suggest the 3 people on this stage, you know what you can do in the different locations, and you advise your clients what you can and cannot do, and that's why they come back to you, and that's why they buy.
And the reason why in Pike County there was an issue where it's lakefront, so they went to clear trees to put a dock, and it wasn't allowed in the HOA governance. So, so something like that is what I'm.
Short-term rentals are a specialized field within the real estate industry. It's like if you were a residential realtor and you go out and you sell a warehouse,
Right.
you might not know the questions to ask. So, I think there's a lot of agents that do a good job. There's probably some that aren't as specialized in the field. And I think the buyers at this point in time, I like to think that a lot of the buyers kind of have an idea of the agents to use, and ones that if they ask some questions they don't have the answers ready, it's maybe not a good fit.
Okay, thank you. And then the next question, and if you just want to keep it, Xander, and we'll go right down. How should they validate income projections? And this is part of the short-term rental due diligence checklist.
So a lot of a huge thing in our market, and I think we can all talk to this, is, and was spoken to a little bit during Avery's speech, it's influencers. And influencers can be different things. They could be advisory groups, they could be Airbnb in a box, they can be all sorts of different things. I imagine that the three people on the stage each have some level of experience dealing with people that are in that ecosystem. It's kind of nice to be able to put some of the projection on a third party rather than you have to be the source of the basis. But there's also you also have experience. So when you sell a lot of properties, you hit up your past clients and say, hey, dude, how you doing? Are you doing what you thought you were going to do? Oh, what's your property look like? Send me the link. And if they have a banger and it does what it's supposed to do, you're like, okay, this is a data point. Versus you have someone that's like, oh, yeah, I didn't end up doing this. I didn't end up doing that. And and then it's like, oh, are you doing well? No, I'm not doing well. Okay. So you have experience, anecdotal, experiential evidence that allows you to get a pretty good idea of what a property can and cannot do.
Thank you. Mike, what role does property management analysis play?
I think the property managers play a really important role, and I think they obviously come with a huge cost. But the good news about property managers is that if you pick a good one, then that you're going to have an optimized listing and you're going to have really good performance. And I've seen that come into play too when you sell the property. That something with a property manager is going to have great income, and it's going to be pretty easy to sell that property as well. But I always encourage people, this is an art as much as a science, and so I always encourage people to get as many perspectives as possible. Talk to property managers, do as much due diligence as you can, because I have really great projections. So.
Excellent. Okay, and we are wrapping up. There's not much more to ask, but let me just move on to number 9, regulation and HOA influence. Are buyers shifting toward safer municipalities?
Define safe, I guess,
I was thinking the same
probably
thing.
The problem, because you think something is calm and then something bubbles up. So it's a little like the game whack-a-mole. You think everything's fine, then towns react.
Right.
When something happens, and your office reacts when something happens. So it's, we hope that when a bad incident happens, whether it's with a bad host or with a bad guest, we can all kind of deal with that issue and not think we've got to fix the whole thing. Mm-hmm. For the most part, what we've got in place, we've got plenty of rules. We've got plenty of enforcement. Maybe we need more enforcement, but it's like, let's enforce the rules rather than just make more rules. Because the rules just seem to be squeezing out the people who are trying to play right by adding burden, and the ones who aren't playing right don't look at the rules and aren't listening to them.
Yep, and our rural districts are basically state police, but we have Stroud Area Regional and Stroud Township, East Stroudsburg. Delaware Water Gap has a part-time force, Pocono Township. So it is hard to say what's safe, and I just wanted to see.
Yeah, but that's also.
And the HOAs have security
You got
at some
Airbnb
point.
in this too. So if you are a host and there's a problem that you've picked up on your cameras, then you should be going back to Airbnb and saying, help.
Okay.
The people you put in my house are messing it up. And you should have a disaster plan for that. If you're a good operator, you should know what to do otherwise.
Yep.
We've heard great use of constables. Get a constable to go out and serve notice that your rental is over, time to leave.
Yep. Well, thank you. And Mike, how are new rules shaping pricing?
Yeah, I think we talked about some in terms of like occupancy. Each township kind of has their own rules, and I think that plays a big role in terms of what you actually, in terms of what you can price per night. Certainly, I think, and from the regulatory side, and a township is going to play it, is going to implement a rule like, Paradise Township, I guess, just had some new thing that they did. They don't allow new short-term rentals, so they have to be grandfathered, but they basically capped it at 4 bedrooms, and there's only 28 short-term rentals there. But I had a couple clients, and they had invested all this property, and so I think they're going to grandfather it in, but it becomes very hard for that person to ever actually sell their property when Paradise Township clearly is taking very draconian measures.
Thank you. Okay, we're going to move on to 10, which is the final topic. So we'll start with you, Mike. Are we entering a professionalization phase?
Yeah, definitely. I mean, I think, the Poconos has always had so much opportunity, and I think people have been coming here for, over 100 years. And so it's really exciting to me to see, the Poconos grow, and there's so much investment going in, and the properties are getting nicer. Some of the communities are getting nicer. So I really feel like we're at a juncture that's very interesting specifically for the Poconos. And so definitely I think, that's what it takes to enter the game and be successful, is to really think about it like a business. But I think that's an exciting prospect for our area if we do it responsibly and look at it from all angles.
Thank you. Mark, are we entering will amenities escalate further, in your opinion?
Sure, it's capitalism. It's if that's what people look for, that's what's going to bring the people here. And to Mike's point, I think it's also important for all this concern about regulation. I think, Terry, you almost mentioned that this has been new since 2015. Well, no. My great-grandfather might have come here to go cross-country skiing. But
you know what I mean, though. Right.
But these vacation homes were built.
Penn Estates was a vacation community, even when I was growing
and
up.
Almost like, why do you have the right to come and live in this house, which was built as a vacation home?
I totally understand. Yeah, I'm just saying for the municipalities making their own rules and where, how to designate these areas so it wasn't a free-for-all is all I'm saying.
Yeah.
Right. Okay. And then last but not least, Xander, the last question. What should investors prepare for over the next 2 to 3 years?
In general, what should they prepare for?
Mm-hmm. The topic was, where is the short-term rental market heading? So what should they prepare for in the next 2 to 3 years? Going into 2030, let's just say, since it's kind of right around the corner.
Prepare and invest. My personal opinion is right now, if you buy the right type of property, your value in the short term will go up. If you are able to deliver it's a national story. So in general, the Poconos is still an affordable market from a revenue versus price standpoint. You look somewhere like the Smoky Mountains, you pay $1 million for a house, you get $125,000 in revenue. You pay $1 million for a house in the Poconos, you better be able to crank that house pretty damn close to 200 or 200 plus. So until that formula substantially changes, the prices will inherently rise because the investors are not necessarily from New York, New Jersey, Philadelphia. They are coming from all over the United States. And the Poconos now is a targeted area that has a high price or has a low price to revenue ratio, which will continue to drive up the values. My suggestion to people in general is if you are able to deliver on the backside when it's time to go through disposition and sell, a property that has high revenue and is not completely depreciated, you will be able to do well based on the fact that you have good active revenue in a property, an asset that actively performs.
Thank you. So if it's okay, do we have time for a couple more questions? I don't know who's the...
Yeah, so my biggest question is best directed to you being a legislator, but my biggest concern is we look to scale. Is buying a property in a township, will say, where they make a wholesale decision to abolish STRs. Now we're out over a barrel. How likely or unlikely is that scenario?
And that's for me?
Whoever else may want to add to what
Well, a lot of things were grandfathered, obviously, right? So if you're already there, you're already there. So when I was the mayor of Stroudsburg, we, as residential, R1, R2 zones, the people and the families wanted to know their neighbor who was directly next door in a small borough. I am fine with that. And I agree there should be no short-term rentals in R1, R2 districts. There's a place for them. We have, they have their multi, so you could be commercial and residential. They could always be in the commercial, like Main Street is fine for Airbnb, and it's the same in East Stroudsburg. So I say it should be up to the local governments, but what's already there, I believe, is grandfathered. So if they go ahead and change it in 5 years, I think you will be grandfathered in based on the law. That's what I was always told as the mayor. Does anybody have, and as a state rep?
I have a comment on that. So in Pennsylvania, I don't know how long or how many investments you have or how long you've been doing it here, but everything kind of stemmed from a big court case that occurred right around COVID. The Slice of Life case, there was a property in Hamilton Township backed up to a creek in a very residential rural area. Basically, they were stacking 20 people in there. They got knocked out by the township. Township said you can't do it. Went to Pennsylvania Supreme Court. The guy who owned the property didn't show up in court. Pennsylvania Supreme Court ruled that de facto you cannot have short-term rentals in low-density residential districts. They are not considered a single-family home. And then all the townships adopted ordinances shortly thereafter to either allow them or not allow them in specific areas. Generally speaking, in my opinion, that has remained fairly stable since about 2022, where they've kind of adopted an ordinance and they've kind of stuck with it. Yes, they've added some, hey, we need more verification of, oh, we need the hot tub permit and we need this and we need that. But generally speaking, that's kind of remained uniform. Also, you have to understand now there are so many short-term rental investors, and short-term rental investors are investors. They have money. The township goes in and tries to kill short-term rentals and tries to do it in a way that you're not going to have grandfathering. They're going to get sued to high heaven, and that's not going to hunt because they don't have the money to fight that court case.
Yep.
I also think ultimately, these homes were built as vacation homes, many of them, and the intended use is a vacation home. And whether somebody comes and stays for free or whether somebody pays doesn't change the fact that what's happening in that home is the way the home was built. So we have a court below the Supreme Court in Pennsylvania called the Commonwealth Court. And Commonwealth Court had a couple of decisions a few years ago that essentially affirmed that what happens in a vacation rental is what the home was built for. So you sleep in it, you eat in it, you relax in it, you go out back and maybe barbecue. Those are not egregious things. So I think the designations in Slice of Life miss that point. So I do think they're vulnerable. But I also think that, and if you're after lunch, you can hear Attorney Eric Smith, who's really good at this, help us put it all in perspective. Because, again, we're using the home as it was intended. And so if you're, especially in an HOA, HOA are governed by covenants. It goes back to the original covenants. And that's really what should guide the investment decisions. And if boards stray from that, at least courts seem reasonable, not necessarily in blanket terms, but on the specific case.
Anybody else? Because there's another question that I have that I get calls for all the time, and it has nothing to do with the realtors. I want to be clear. It is people who live in HOAs saying they're violating our ordinances. And it's so hard because when you are part of an HOA, I can't help you. You have your own governance. And sometimes that gets a little bit kind of messy. There's a HOA Association of Pennsylvania that basically says the same thing. Well, then you got to remove your board of directors at your HOA, you know? So I wanted to just answer everyone that never would I blame a realtor for these complaints that are coming in. And it's usually just bad actors and, you know, what can you do with that? But on the flip side, I do want to ask about the people. So I'm going to use Oh, okay. You had to stop me then at the 8 minutes. Okay, everyone, thank you so much. I hope you learned something today. Thank you.